for decades, really. When people talked about global finance, especially in the West, China's stock market interventions were fascinating, but also viewed with a lot of skepticism.
Right. Skepticism because, it seemed to fly in the face of free market ideas. Fascination because sometimes it looked like it actually worked to stop huge crashes.
Exactly. And for years, the U.S. approach was just watch, observe from a distance.
Yeah.
But that whole conversation, it's really shifted now, hasn't it?
It really
The
has.
question isn't just what's China up to anymore. Now it's could the U.S. actually borrow from that playbook? I mean, could the government literally step in
Yeah.
and buy stocks during a crisis?
It sounds radical, doesn't it?
It does. And that's what we're digging into today. We're going to look at China's tactics, analyze that really crucial precedent the U.S. set back in 2020, quietly but importantly,
Yeah.
and then weigh the arguments. Is this some kind of necessary shield for, your retirement accounts, your 401k, or is it just a dangerous path away from free markets?
And it really pushes the boundaries of what's considered acceptable, that Overton window idea.
Explain that a bit.
Well, it's the range of policy ideas that are sort of politically palatable at any given time, direct government stock buying, that used to be firmly outside the window for the U.S. Reserve for state-run economies.
But now,
Now, because the Fed's usual tools might be running low, it's being seriously discussed, almost like a nuclear option for the next big financial meltdown. It challenges some core beliefs about American finance.
okay, so let's start with China's playbook itself. What are we actually talking about? It's not just tweaking regulations, is it?
No, not at all. It's active, boots-on-the-ground participation. The state becomes a massive investor, directly influencing the market.
And this is the so-called national team.
That's the term, yeah, the Guojia Duik. But it's important to know it's not like one single government department called the Ministry of Stocks. It's more like a network. A collection of state-owned or state-controlled financial giants, banks, investment funds, all coordinated from the top to stabilize things when needed.
So who are the key players? The ones with the real firepower?
Well, there are two main tools they deploy. First, you've got the China Securities Finance Corporation, the CSF. They do margin lending, sure, but their big crisis role is directly buying shares, just wading in and buying.
Okay.
And second, there's Central Huijin Investment. Think of them as the investment arm of China's massive sovereign wealth fund.
Uh-huh.
When the big state-owned banks or major companies start to really falter in a crash, Huijin is the explicit backstop. They inject capital right into the shares.
So they're like the ultimate buyer of last resort, but for stocks.
Pretty much. And the scale. Well, it's just mind-boggling sometimes. The 2015 crash in China is the classic example.
Right, I remember that. Things were in free fall.
Absolute free fall. So
Yeah.
they unleashed the national team. Estimates suggest they poured something like $200 billion into the market almost immediately.
Wait, $200 billion?
Yeah. I mean, think about that number. That's bigger than the entire economy of some countries.
Wow.
And they weren't just buying the big blue chips. They bought across the board smaller companies, too. The goal wasn't profit. It was shock and awe stabilization.
Just stop the bleeding.
Exactly. Stop the panic, try to restore some confidence, and crucially, prevent the market crash from spilling over into the streets, causing real economic pain and maybe social unrest.
But achieving that stability, that immediate calm, it must come with some pretty serious long-term costs, right? If the state is always there to catch the market.
Oh, absolutely. Huge costs. The biggest one, economists always point to this, is the damage to price discovery.
Okay, what does that mean in practice?
Well, in a healthy market, a stock's price reflects, the company's actual health, its prospects, its value. But if the government is poised to jump in and buy whenever prices dip too low...
Then the price doesn't mean the same thing anymore.
Exactly. The price starts reflecting the government's willingness to intervene, not the company's fundamental worth. And that's a massive distortion.
So how does that broken price signal hurt the wider economy? What's the knock-on effect?
Well, the whole point of a free market, arguably, is efficient capital allocation. Falling prices signal that resources, investment, should maybe go somewhere else to more promising ventures.
Right, or survival of the fittest, economically speaking.
Sort of, yeah. But if the state props everything up or props up the whole index, you kill that process. You end up protecting companies that maybe should fail. Critics call them zombie companies.
Zombies.
Yeah, firms that aren't really efficient or innovative, but they just kind of shamble along because the overall market is being artificially supported. That traps capital, slows down innovation, and ultimately drags on growth for everyone.
And if you know the government's going to catch you if you fall,
Yeah.
that sounds like a recipe for moral hazard.
Bingo! That's the other huge problem. Moral hazard is basically when you take on way more risks than you should because you think someone else, in this case the government, the taxpayer, will bail you out if things go wrong.
So if investors expect this kind of government put under the stock market,
They'll just take wilder bets, right? Knowing there's a safety net. It encourages excessive risk-taking, helps inflate bubbles even bigger, and potentially sets us up for an even worse crash down the line because everyone assumed the bailout was guaranteed.
and that danger, the moral hazard, the distorted prices, that's precisely why the U.S. Federal Reserve has always historically drawn a very clear line.
A very bright line.
They manage interest rates, they buy government bonds, maybe mortgage bonds through QE, quantitative easing,
Influencing the cost of money, the supply of money.
but they stayed out of directly owning or propping up specific companies or the stock market itself. They didn't pick winners and losers in the corporate world.
That was the firewall. It was fundamental to the U.S. system. But then came 2020, and the ground shifted dramatically.
The COVID crash.
That was the watershed moment, the precedent we really need to understand for this conversation.
Okay, so the crash hits. It's incredibly fast and brutal. The government responds. What exactly did the Fed do to cross this line?
Well, the Treasury authorized the Fed to set up a bunch of emergency lending facilities, but the crucial one, for our purposes, was the Secondary Market Corporate Credit Facility, or SMCCF for short.
SMCCF.
Okay. And here's the kicker. The SMCCF was given the power to buy corporate debt, investment-grade corporate bonds, and, this is key, also bond ETFs, exchange-traded funds.
Hold on. So the Fed buying corporate bonds, even via an ETF, that was new territory, right? Why is that such a big step towards potentially buying stocks?
Because while a bond is debt, not equity, an ETF, even a bond ETF, trades on an exchange just like a stock. It represents a basket of corporate securities.
Okay.
By buying those, the Fed was, for the first time, directly intervening in the market for corporate securities, influencing the value and stability of actual American companies. They weren't buying stock, but they were supporting the corporate entities that issue the stock.
So the principle was breached.
The principle was definitely breached. The genie was kind of out of the bottle. The U.S. government proved it could be a direct player in corporate securities markets if things got bad enough.
And once that door is opened, even just a crack,
The intellectual debate just floods in. You started seeing prominent economists saying, okay, if the Fed can buy corporate bonds, why not corporate stocks in a real catastrophe, especially now?
because their traditional toolkit is depleted.
Exactly. Interest rates are already so low globally. The Fed can't just slash rates by 5 points like they used to. They need other options. So the question becomes, what if, in a future nightmare scenario, Congress gave the Fed emergency powers for the ultimate intervention, the nuclear option, as some call it?
Which is actually buying stock market indexes, like the S&P 500 ETF, the SPY, or the NASDAQ's QQQ.
That's the proposal that's now being seriously, if cautiously, debated. Buying a broad index-based ETF.
Wow. Who's pushing this, and what's their justification? It still feels like a massive leap from buying bonds.
It is a massive leap, and the critics are loud, believe me. But the proponents' argument basically boils down to the Fed's mandate.
Which is price stability and maximum employment.
Right. So they argue if a catastrophic stock market crash threatens both of those things by destroying household wealth, crushing confidence, tanking spending, causing mass layoffs, then shouldn't the Fed use the most direct tool possible to stop it?
And buying the whole market index is seen as more direct and maybe more impartial than buying individual bonds.
That's the idea. Buying an index like the SPY means you're not picking specific company winners or losers. You're just supporting the whole system. They argue it offers immediate, broad confidence without direct corporate favoritism.
Okay, let's break down the potential upsides then. If the U.S. were to actually consider this, what's the argument for doing it? Playbook 2.0, you called it.
Well, number one is just the sheer shock and awe stabilization effect. Imagine the Fed, backed by Congress, actually announcing, if the S&P 500 falls more than, say, 3% today, we will step in and buy X billion dollars worth of an index ETF.
The panic would likely stop on a dime, wouldn't it?
Instantly. That announcement alone could be the ultimate confidence booster. It signals an unbreakable floor under the market, at least temporarily.
And then there's the argument that resonates more with the public, perhaps. protecting Main Street. This isn't just about Wall Street.
Right. And you have to look at the reality of who owns stocks today. It's not just the super rich.
What are the numbers?
Over 60% of American households have exposure to the stock market now, mostly through retirement accounts. 401ks, IRAs, pensions.
So a market meltdown directly hits the retirement savings of tens of millions of people.
Exactly. It craters household wealth, kills consumer confidence, people stop spending, and that can throw the whole economy into a deep recession, or worse. So proponents say stabilizing the market isn't a Wall Street bailout, it's protecting Main Street's financial security.
Okay, so shock and awe, protecting Main Street.
Yeah.
What's the third pillar of the argument?
Basically, necessity. The argument that the financial threats we face now, pandemics, cyber attacks, sudden bank runs, climate-related shocks, are faster, more complex than before.
And the old tools, like slowly adjusting interest rates, are too slow or too weak.
That's the claim. They see direct market intervention, this nuclear option, as a potentially necessary tool for a 21st century crisis toolkit to be used only when everything else fails.
All right, that's the case for it. But now, the risks.
And listening to the critics, these risks sound potentially catastrophic. They argue it could fundamentally change American capitalism for the worse.
They really do. And the number one risk, going back to the China example, is the death of price discovery. We touched on it, but let's be clear how damaging that is.
If the Fed puts a floor under the index, what happens?
The market stops doing its most important job, figuring out what companies are actually worth and allocating capital efficiently. If bad management, bad products, bad strategy don't lead to a falling stock price because the whole index is propped up.
There's no real consequence.
Right. You effectively subsidize failure. You get more of those zombie companies we talked about, inefficient firms that should shrink or fail, freeing up capital and talent for new innovative companies. But instead, they linger, dragging down overall productivity. And the moral hazard issue we discussed, it becomes even worse if the Fed is directly buying stocks.
Oh, moral hazard on steroids. If investors truly believe there's a Fed put directly under the stock market index itself, not just bond markets.
Why wouldn't you take massive risks?
Precisely. It incentivizes reckless speculation. People might pile into riskier assets, lever up more, assuming the Fed will cushion any major fall. It could inflate the biggest bubble we've ever seen, making the eventual correction, if it comes, even more devastating.
Okay, destroying price discovery, turbocharging moral hazard. What else keeps critics up at night?
The political nightmare. This one is huge. The Federal Reserve's independence, its insulation from short-term political pressure, is arguably its most valuable asset.
Why is that so important?
It allows the Fed to make tough decisions based on long-term economic health, not based on who's in the White House or what might help win the next election.
And if the Fed starts buying stocks?
That independence is gone, instantly. Can you imagine the lobbying?
Oh yeah, Congress members demanding the Fed buy index funds weighted towards industries in their districts.
Or a president pressuring the Fed's share to juice the market before an election. It would be relentless. The Fed becomes just another political football.
And its credibility, its public trust would just evaporate?
Completely. And once that's gone, it's incredibly hard, maybe impossible to get back. Monetary policy relies heavily on credibility.
Okay, that's a terrifying prospect. Is there one more major risk?
Yes, the exit problem. It's the elephant in the room. Let's say the Fed does intervene, buys hundreds of billions, maybe trillions worth of stock ETFs to stop a crash.
Then what? The crisis passes.
Yeah.
How do they sell it all?
Exactly. If they start selling that massive stake, wouldn't that just trigger the very crash they were trying to prevent in the first place? They created the floor, pulling it away risks collapsing the building.
So they might never be able to sell.
That's the fear, that this temporary emergency measure becomes permanent. The government becomes a permanent large-scale owner of U.S. corporate equity. That's not tweaking capitalism. That's fundamentally altering the relationship between the state and the market in America.
Okay, so summing this up, if you're listening and maybe checking your retirement account balance nervously.
Don't panic.
Right. The U.S. is definitely not about to start buying stocks tomorrow. The legal hurdles are massive. The political opposition would be intense. And there's a deep, almost cultural resistance to the government intervening this directly in the stock market.
It's still a huge step. However, and this is the crucial takeaway from our dive today, the conversation has changed. That Overton window we mentioned, it has shifted.
What was unthinkable before is now thinkable.
Think about it. In 2007, the idea of the Fed buying corporate bonds was unthinkable to most. By 2020, faced with a crisis, they did it.
So the precedent is there.
And the theoretical groundwork for buying stock indexes is now being laid, being stress tested in serious economic circles. Policymakers are aware that the next crisis might be even bigger, faster, and might demand even more unprecedented actions.
Which leaves us, and leaves you listening, with a really profound question for the future. When the next massive financial crisis hits, and history suggests it will, how far are we willing to go?
Yeah.
In that desperate scramble to prevent, say, another Great Depression, are you willing to sacrifice bedrock principles of free market capitalism, like accurate price discovery, like avoiding massive moral hazard, like keeping politics out of the central bank if that sacrifice is presented as the only way left to save the entire system from imploding?
That's the potential trade-off, saving the system by fundamentally changing what it is.
A tough question, and one we might face sooner than we think.